My name is Steven Strickland, and I'm a certified financial planner and the president of Wise Wealth. I've been helping people plan for retirement for over 15 years, and today I want to help you by helping you understand and plan for inflation, or what I like to call the sleeping giant. What is a sleeping giant? It's someone or something that you don't want to wake up, but at some point, it's going to wake up on its own. Inflation is real and it's coming for your money. A simple definition of inflation is a decrease in purchasing power due to an increase in the purchase price of goods and services. Over time, things cost more and more. Inflation impacts us throughout our lives, but it's very important to plan for the impacts of inflation during your retirement years when your income may not keep up with your expenses since you're no longer getting pay raises for doing work anymore. For example, in retirement, if you have an income goal of $5,000 a month, over time, that same $5,000 may only be able to buy what $2,500 buys today. Another way to say it is if you start retirement with an income need of $5,000 a month, over time, your income may need to increase to $10,000 a month just to maintain your lifestyle. And there is a way to do that, and I'm going to explain it in the next few minutes. I believe that there is one crucial concept everyone must understand in order to beat inflation, and that is this: know the difference between saving and investing. Most people use these terms interchangeably, but they are not the same. The difference is where your money goes and what it is doing. If your money is just sitting there, that's saving. If your money is working for you, that's investing. If you want to beat inflation, you have to be an investor. Don't get me wrong, there's a place for saving and investing. Saving is usually done at a bank. You need savings for emergency funds and short-term known or planned purchases or expenses. If you have an expense coming up, let's say within 3 to 5 years, you can put that into savings. And your emergency reserve should always be in savings. Another way to look at savings is cash or an account that is liquid and safe. The problem with savings is that the rate of return on that money does not keep up with inflation. If inflation is 3% every year, meaning the cost of goods and services go up by 3% per year, and your savings account is growing by 1% per year, which would be amazing, that means you're actually losing 2% per year in your money's ability to keep up with prices. This is okay for your emergency fund and your short-term expenses. The goal with those is not to keep up with inflation, but to keep those funds safe and secure and available for when the need arises. That being said, my advice is always to fully fund your emergency fund or savings accounts, but don't overfund them. Why? Because you're actually losing value if you do. So what is investing? Investing is when you take your money and put it into products or investments that have the ability to beat inflation. In my example, you would need to invest in things that grow by more than 3% per year just to break even. So preferably, you want to invest in such a way that you are earning a lot more than just 3% per year. Here's a little rule of thumb to remember. Until you are earning more than 3%, you are not earning anything. Another way to look at it is this: the real amount that you are earning is only the amount above 3%. But investing is not for your emergency fund or short-term goals within 5 years because there is market risk associated with investing. And many times the funds are not as available as they are if they're sitting in cash. So investments are for any of your money that you need in the future, for retirement or for any purchases or expenses sometime after 5 years from now. This is why you can't just base your investment decisions on the answers to a risk profile questionnaire. Most people by nature are risk averse. We never want to see our account values go down. But the reality is, regardless of your emotions or risk tolerance, you have to choose investments that beat inflation, which will involve some risk for your retirement funds or long-term goals, as long as those goals are longer than 5 years away. Even in retirement, it's a mistake to get conservative with all of your assets. You should protect the income and grow the rest. Get conservative with the funds you need to produce your income stream, but then the remaining funds not needed for income, and make sure that they are invested in such a way to continue to beat inflation so that when you need more income, you have a pile of funds to access it to increase it. Here's my advice for every dollar you have set aside. Determine how much you need or may need within 5 years, your emergency fund included, and leave that in savings, a cash type of account that are safe and available. But every dollar you have beyond those short-term goals must be invested, which means put to work for you in things that have the potential to substantially beat inflation. Hey, this is Stephen from the future. At the time I recorded the video I just did on inflation, I since then recorded a podcast. It's about 30 minutes in length. I go into further details about inflation. If you want to get more information about inflation, how it works, everything you need to know about it, how to handle it, make sure you take a listen to the podcast as well. If you'll hit that link, you'll get more information about inflation, and I hope you'll enjoy it too. If you enjoyed this video, feel free to hit the like and subscribe button for more content just like this. I release new clips like this at least twice per month. Thanks again for tuning in. Don't forget to like and subscribe so you don't miss any. See you next time.